Welcome back. If you look at what the internet tells you about getting rich, it always looks like an action movie. It is all about day trading volatile tech stocks, chasing the newest cryptocurrency, or trying to find the next artificial intelligence startup before it explodes. Society has been trained to believe that investing should be fast, exciting, and full of adrenaline. But if you look at the people in your city who actually hold generational wealth, they do not own flashy tech startups. They own concrete plants. They own commercial plumbing companies. They own agricultural land and logistics hubs. The greatest secret of the ultra wealthy is that real sustainable wealth is mind-numbingly boring. The excitement trap is designed to separate emotional amateurs from their money. When an asset is constantly in the news, it is usually too late to make real money from it. Today, we are going to pivot away from the noise. We are going to break down the 5 most boring, unglamorous, and bulletproof assets that the wealthy use to generate massive, predictable cash flow while everyone else is gambling. It is time to embrace the power of boring. Let us start with the single least glamorous industry on the planet, waste management. There is absolutely nothing exciting about garbage. You will never hear someone bragging at a dinner party about their investment in a landfill. But from a pure financial perspective, it is a masterpiece of cash flow. Regardless of what the economy is doing, whether there is a massive recession, skyrocketing inflation, or a global crisis, people will always generate trash. And that trash must be removed. The companies that control waste collection operate as localized monopolies. You cannot simply start a competing garbage company tomorrow. The regulatory hurdles, the massive cost of a fleet of trucks, and the permits required to open a new landfill create an impenetrable fortress around the existing players. Because they face almost zero new competition, these companies have supreme pricing power. Every single year, they quietly raise the fees they charge municipalities and businesses. Their revenues are guaranteed by multi-year government contracts. It is a dirty, smelly business that reliably spits out a clean, growing stream of dividends to its owners. Next, we look at the physical arteries of the economy, the railways. In North America, specifically in Canada, a massive portion of the goods we consume, grain, oil, lumber, and imported products, moves by rail. The beautiful, boring reality of the railway business is that it is physically impossible to replicate. You could have $1 trillion in cash, and you still could not buy the land and lay down new tracks across the continent to compete with the established giants. They own the land, they own the routes, they are pure, unregulated monopolies. Every time a company needs to move a physical product across the country, they have to pay the toll. Then we have the financial toll booths, the major banks. We discussed the traditional savings trap previously, but when you switch from being a customer of the bank to an owner, the math flips in your favor. Canadian banks are highly protected oligopolies. They do not need to innovate with flashy new technology. They simply collect a margin on millions of mortgages, credit cards, and business loans every single day. The model is ancient, entirely predictable, and generates billions in pure profit every quarter. Our 4th boring asset class is utilities, the companies that generate and distribute electricity, natural gas, and water. Think about your own monthly budget. If you face a sudden financial crisis, you will cancel your streaming subscriptions, you will stop going to restaurants, and you will delay buying new clothes. But you will always, without hesitation, pay your hydro bill and your water bill. You cannot live without turning on the lights or heating your home. This makes utility companies virtually immune to consumer recessions. Furthermore, they are heavily regulated, which sounds bad, but it actually guarantees their profitability. Governments allow them to operate as monopolies in their regions, and in exchange, the utilities are permitted to lock in a guaranteed rate of return on their massive infrastructure investments. They build a power grid once, and then they collect mandatory inflation-adjusted payments from millions of households for the next 50 years. It is the ultimate expression of predictable, boring, unstoppable passive income. The final category of boring wealth involves human necessity and human habit. This includes the massive grocery oligopolies and consumer staples. People do not stop eating when the stock market crashes. These companies operate on razor-thin margins, but their absolute scale is so enormous that the cash flow is staggering. Because everyone is forced to shop there, they can pass any inflationary costs directly down to the consumer instantly. We also look at human habits, often referred to as sin stocks, like alcohol or tobacco conglomerates, though many modern portfolios focus purely on the unshakable telecom giants. Just like water, a cell phone connection and home internet have transitioned from a luxury to an absolute, non-negotiable biological need for modern survival. A telecom giant collects $80 to $100 a month from 30 million people automatically, with almost no risk of those customers leaving because the alternative providers are non-existent. These companies do not try to change the world, they simply tax human existence. The execution strategy for the everyday investor is to stop trying to be a genius. You do not need to invent the next big software application. You simply open your tax-free account and buy shares in the massive publicly traded corporations that control these 5 boring sectors. But that the true magic happens when you activate the ultimate boring wealth tool, the dividend reinvestment plan, or DRIP. When you turn on the DRIP every time the garbage company, the railway, or the utility company pays you a quarterly dividend, your brokerage automatically uses that cash to buy more shares of that exact same company. You do not touch it, you do not look at it. The machine feeds itself. You acquire more shares, which pay you more dividends, which buy you even more shares. While your friends are losing sleep over the daily price charts of tech startups, you are quietly letting the most essential functions of human society pay for your early retirement. Step away from the noise, buy the boring infrastructure, let the machine do the work. Shields up.